There is a moment in every market cycle when the price on the screen stops matching reality, and right now, silver has crossed that line. Not quietly, not gradually, but suddenly and unmistakably. Because when dealers begin rejecting dollars, when inventory disappears overnight, and when premiums explode beyond anything the chart explains, the message is simple. The number you see is no longer the price. It is a placeholder, a memory, a delay. This is not about silver touching 67. That number is already obsolete. The real transaction price, the one people are actually paying behind closed doors, is closer to 75. And the reason you are not being told that openly is because the system cannot afford for you to know how fragile it has become. Over the past few weeks, something unprecedented has been happening across the physical silver market. Dealers are not discounting. They are not negotiating. They are not competing for your business. Instead, they are freezing sales, pulling listings, quoting absurd delivery times, or offering prices so high they seem like errors. But they are not errors. They are warnings. When a dealer tells you, "We are out of stock," what they are really saying is, "We cannot replace what we sell." Replacement cost has become the enemy. Selling silver at today's screen price means risking insolvency tomorrow. Because if silver opens higher next week, and the week after that, the dealer who accepted your dollars today will need far more of them just to restock the same metal. That is how a market breaks. Not with headlines, not with alarms, but with silence. With websites quietly going into maintenance mode. With inventory counters mysteriously stuck at zero. With customer service emails that stop promising dates and start offering refunds. This is the point where money stops working the way you expect it to. Dollars are supposed to buy things. That is their job. But silver is no longer being priced in dollars alone. It is being priced in risk, in scarcity, in uncertainty, and in fear. Because here is the truth that most people still do not understand. The silver market is not driven by investors anymore. It is driven by necessity. Industrial demand is no longer optional. Solar panels do not work without silver. Advanced batteries do not exist without silver. Medical equipment, electronics, defense systems, all of them depend on silver, and none of them care what the futures chart says. They care about delivery. And delivery is where everything is breaking. On paper, the world appears well supplied. On paper, there are hundreds of millions of ounces available. But paper silver cannot be melted, wired, or installed into a production line. Paper silver only works as long as nobody asks for the real thing at the same time. That illusion is ending. As prices climbed through the 60s, something critical changed in dealer psychology. At 50, selling inventory felt safe. At 60, it felt cautious. At 67, it felt reckless. Dealers began asking themselves a dangerous question. What happens if I sell today and cannot buy back tomorrow? That question is now being asked everywhere. From local coin shops to global wholesalers. From private vault operators to international trading desks. And once that question enters the system, selling stops being automatic. This is why you are seeing the spread explode. Spot price says one thing. Reality says another. The gap between them is not greed. It is insurance. It is the dealer protecting themselves against a market that no longer behaves normally. And when that gap grows wide enough, something extraordinary happens. The official price loses authority. Think about what 75 really represents. It is not a prediction. It is not a target. It is a reflection of stress. It is the price of required to convince someone to part with something they believe will be harder to replace tomorrow than it was today. This is why offers are being refused. This is why cash is being returned. This is why some dealers would rather hold metal than money. Because money can be created instantly. Silver cannot. Behind the scenes, the pressure is building. Futures markets remain open, trading promises back and forth. But physical markets are tightening like a vice. Bars are being pulled from vaults. Shipments are being rerouted. Contracts are being renegotiated quietly, off the screen, away from public view. And while all of this is happening, most people are still staring at a chart, waiting for confirmation. But confirmation already came. It came the moment silver stopped behaving like a commodity and started behaving like a strategic resource. Once that happens, price discovery changes. It no longer flows from exchanges downward. It flows from scarcity upward. The screen chases reality instead of defining it. This is why 75 matters. Not because it is where silver will stop, but because it is the first number that acknowledges what is already happening. And the most dangerous phase of any market is the moment just before everyone else realizes the rules have changed. Because when the realization finally spreads, when the question shifts from should I buy to can I still get any, the move is not gradual, it is violent. The system is not designed for everyone to demand delivery at once. It never was. It was designed for confidence, for trust, for quiet compliance. But confidence is fading, and trust is being replaced with urgency. And that urgency is exactly why dollars are being rejected. That urgency is spreading faster than most people realize, because it is no longer confined to investors or collectors. It has reached the people who cannot function without silver, the ones for whom silver is not a trade, but a requirement. And when necessity enters a market already under strain, price stops being negotiated and starts being dictated. Industrial buyers are not waiting for pullbacks. They are not watching candlestick patterns. They are not debating whether 67 is overbought. They are looking at supply chains, production schedules, and contractual penalties. If a factory misses delivery, the cost is not theoretical. It is immediate and massive. Entire lines shut down. Contracts are breached. Market share is lost. So when these buyers step in, they do not ask for spot. They ask one question only. Can you deliver, and how fast? This is where the real price emerges. Because when a buyer needs metal now, not in 3 months, not rolled forward, not settled in cash, they will pay whatever clears the shelf. That is why 75 is not shocking inside the industry. It is already being absorbed quietly in private deals, in long-term supply agreements, in direct arrangements between miners and end users that never touch a public exchange. This is another critical fracture forming beneath the surface. The traditional market assumes silver flows from miners to refiners, from refiners to exchanges, from exchanges to users. That chain is breaking. The metal is being intercepted earlier and earlier in the process. Some of it never becomes an exchange bar. Some of it never enters a reported inventory. It is sold forward, locked up, and removed from circulation entirely. Every ounce that bypasses the public market increases the pressure on the remaining supply. And that pressure expresses itself through premiums, delays, and refusals. Dealers are not trying to be difficult. They are trying to survive. Now add another layer to this problem. Leverage. The paper-silver market is built on leverage stacked on leverage. For every physical ounce, there are dozens of claims. This works beautifully when most participants want exposure, not delivery. But when confidence erodes, behavior changes. People stop asking, what is my position worth? And start asking, where is my metal? That shift is subtle at first. A request to allocate. A request to segregate. A request to move bars from one vault to another. But each request tightens the system. Each request forces someone else to scramble. And scrambling is expensive. When large holders convert unallocated positions into allocated metal, the institution holding that liability must either assign existing bars or go into the market and acquire them. If the bars are not readily available, the institution pays up, quietly, aggressively, without hesitation. This buying does not show up as volume spikes on retail platforms. It does not create dramatic candles on your chart, but it drains inventory all the same, and it raises the true clearing price. This is why the disconnect feels so confusing. The screen tells you one story. The physical market tells another. And the longer that gap persists, the more unstable the system becomes. Historically, this is how repricing events begin. Not with a clean breakout, but with a refusal. A refusal to sell. A refusal to quote. A refusal to accept the old unit of account as sufficient compensation. Dollars still work, but only in larger quantities. And that is the signal. When $70 no longer clears supply, 75 steps in. When 75 becomes common, 80 follows. Not because of speculation, but because that is what balances urgency against scarcity. This is also why volatility is increasing. The market is searching for a level where sellers feel safe again. And that level is much higher than most models predicted. The longer silver trades below its true clearing price, the more violent the adjustment becomes when the recognition finally arrives. That is why these periods feel chaotic. Prices jump, offers vanish, rumors spread, and everyone senses that something important is unfolding, even if they cannot articulate it yet. What makes this moment especially dangerous for the existing system is that trust is being withdrawn gradually but relentlessly. Each delayed shipment erodes confidence. Each canceled order confirms suspicion. Each premium hike reinforces the idea that the quoted price is no longer anchored to reality. Once enough participants internalize that belief, behavior changes permanently. People stop selling casually. They stop trading for small gains. They start holding for security. And silver, historically, is what people hold when they no longer trust abstractions. This is not about fear in the emotional sense. It is about rational response to structural stress. When supply chains tighten, when geopolitical risk rises, when currencies are diluted, tangible assets regain their original role. They become insurance. That is why dealers are rejecting dollars. Not because dollars are worthless, but because silver is becoming priceless relative to them. And this process does not reverse quickly. Once trust breaks, rebuilding it takes time, transparency, and actual metal. Not promises, not contracts, not reassurances. Which brings us to the most important realization of all. The people still waiting for confirmation from the screen are already late. The market has moved ahead of them. The repricing is underway, just unevenly distributed. Those closest to the metal see it first. Those furthest from it see it last. And by the time the last group realizes what happened, the price they remember no longer exists. That lag between realization and reaction is where the most damage is done, because once the crowd understands that access is the real problem, not price, the scramble becomes uncontrollable. This is the phase where logic gives way to urgency, where careful accumulation turns into aggressive acquisition, and where the remaining supply is pulled forward in time all at once. You can already see the early signs of this behavior forming. Buyers who once spread purchases over months are compressing them into days. Institutions that planned quarterly allocations are front-loading entire years of demand. The timeline is collapsing, and when time collapses in a constrained market, price has only one direction left. This is why the idea of silver being overbought no longer applies in the traditional sense. Overbought assumes excess enthusiasm relative to fundamentals. But enthusiasm is not driving this market. Replacement risk is. Delivery risk is. Strategic risk is. And those forces do not cool off just because an oscillator flashes red. In fact, elevated prices make the problem worse before they make it better. Higher prices signal scarcity, which encourages hoarding, which tightens supply further. That feedback loop continues until one of two things happens. Either production expands meaningfully, or demand is destroyed. Neither of those outcomes is imminent. Mining supply cannot surge overnight. New projects take years, not months. Environmental regulations, capital costs, and declining ore grades act as brakes, not accelerators. Even if prices stay elevated, the physical response lags far behind the financial signal. Demand destruction, on the other hand, would require industries to stop using silver. That is not realistic. There is no substitute at scale for many of silver's critical functions. You can thrift usage at the margins, but you cannot eliminate it without redesigning entire technologies. That process takes time and introduces new vulnerabilities. So the market remains trapped between rigid supply and inelastic demand, with a currency layer on top that is losing purchasing power. That combination has appeared many times in history, and it always resolves the same way, through repricing. What makes this moment unique is the speed at which information now spreads. A dealer freezing sales in one region is noticed instantly by buyers everywhere. A premium spike at one wholesaler ripples across platforms in hours. Confidence evaporates not over years, but over weekends. And when confidence goes, velocity increases. People do not wait, they act. This is the stage where stories begin circulating, not officially, but informally. Stories of orders canceled, of shipments delayed indefinitely, of vaults rationing withdrawals, of preferred clients receiving metal while others are offered cash settlements instead. Each story reinforces the same conclusion. Physical silver is harder to get than it should be at the quoted price. At that point, the market stops asking whether 75 is justified and starts asking whether 80 will be enough. This is also where policymakers become uncomfortable. Rising silver prices expose more than just a commodity imbalance. They expose stress in the monetary system itself. Silver has always been a barometer. When it moves sharply, it signals distrust in paper promises. Authorities prefer controlled adjustments, gradual inflation, predictable trends. Silver does not cooperate with that narrative. It moves when trust breaks, not when permission is granted. And once silver begins repricing openly, it tends to pull other assets with it. Gold follows. energy follows. Hard assets across the board begin reflecting the same message. Scarcity matters. Tangibility matters. Claims matter less. That is why silver is often dismissed until it cannot be ignored. It remains quiet for long periods, then speaks all at once. We are entering one of those speaking moments. The resistance you are seeing now is not from the market. It is from psychology. From people anchored to old numbers, old charts, old assumptions. From the belief that because something traded at a certain level yesterday, it must trade there again tomorrow. But markets do not owe consistency. They owe balance. And balance is achieved through price. 75 is not the ceiling. It is the admission price. It is the level where sellers begin to feel compensated for the risk of parting with something they may not be able to replace. It is the level where dollars regain some leverage temporarily. But even that leverage is fragile. Because once buyers accept 75 as normal, it becomes the new baseline. And from there, the same forces resume their work. This is why waiting for the pullback becomes dangerous. Pullbacks occur in liquid markets with abundant supply. They become shallow and brief when supply is constrained and demand is urgent. The dips get bought quickly, sometimes invisibly, before most participants even see them. And when the pullback never arrives, hesitation becomes regret. None of this means price will move in a straight line. Volatility will increase. There will be sharp swings. There will be moments of doubt. That is the nature of transition. But direction and turbulence are not the same thing. Direction is set by fundamentals. Turbulence is set by emotion. Right now, fundamentals are winning. The quiet rejection of dollars by silver dealers is not an act of defiance. It is an act of self-preservation. It is the market protecting itself from an imbalance that paper prices can no longer mask. When history looks back on this period, it will not focus on the exact week silver crossed 67. It will focus on the moment access changed, the moment price stopped being the gatekeeper and availability took its place. Because once access becomes the constraint, money chases metal, not the other way around, and that is when repricing accelerates beyond expectation. So if you are wondering whether 75 is real, understand this. Reality is not defined by charts. It is defined by transactions, by what clears the market, by what convinces a holder to sell and a buyer to commit. By that measure, the real price has already moved on. The screen will catch up eventually. It always does. But by the time it does, the conversation will no longer be about whether silver is expensive. It will be about whether any is left.